well, in some ways, I'm a little shocked, I suppose, to see how people from opposite ends of the political spectrum can have a common analysis of what the problem is. And I think we have clearly seen what the problem is, and no problem there. I mean, I agree totally with what they've said. But I come from a very different perspective in terms of both the causes and the solutions. And it is a failure of the capitalist market. It is. Capitalism and fractional reserve banking came together. They need each other like drunks holding each other up. You cannot have one without the other. And capitalism must go into its financial stages. It must go into its speculative stages because that's what it's all about. What else is capitalism? The assumption behind what we've heard from the last two speakers really is a lot about the idea of perfect markets. That if only all these nasty things weren't around and people would relate to each other. But I mean, you've got things like ownership of property and all these type of things, which and the need to pay interest and earn interest, and where does that come in a fixed money system? So where does profit come from? How does profit happen? There's lots of questions I would like to ask. But I think one of the things that comes up very clear, what neoliberalism's great triumph in what has happened recently, is it's made us not trust ourselves as citizens any longer, or trust our commonality of citizens, which is our state, and only to trust ourselves as consumers. So I think we have a democratic deficit big time, and that is the problem we have. And I see the money system as really being a way through this. I see money as utterly social and utterly public. And I call this money is us, because money is arguably the most socially based institution in our society. It's based on social trust and public authority. And the issue and circulation of money, has been privatized in modern economies. And this is what has led to crisis and public rescue. It's not the problem of the state, the central bank and all the rest of it. It is to do with the fact that the whole issue of money has been privatized and it has got completely out of any control. And I want to argue very clearly that money is and should be a public resource. It is something that is ours, it's us, it belongs to us, and we should administrate it. We've seen, in fact, the public rescue of banks, haven't we? Banks are a system of trust that have no means of withstanding a run. The fractional reserve, I mean, we've had a fair good agreement between us all. The fractional reserve is a bad system anyway, and the reserve is a meaningless concept, and the crisis is 100% or nothing. The central bank, the state, has been the lender of last resort, and we've seen that the financial system we've got has had to be rescued by the public, and only the public. There was nothing else, and it's bankrupted countries. The money supply was going 4 or 5 times out of control of the GDP of countries, including poor Iceland, for example, and Ireland is now tottering. Banking is a public issue. It can never be a private issue. Why did the demise of Lehman's, an investment bank, nearly bring down the Western banking system? It wasn't a high street bank at all. It didn't take deposits. So how come it nearly brought everything down when it was allowed to go crash? Why, when the Icelandic problem happened, did people rush? Not the Icelandic government, they rushed to the British state and demanded, 288,000 people I think it was, demanded their money be secured. Why did the British government have to secure the banking system of another state? Now I know they're only lending it to Iceland, but I mean Iceland is in real trouble trying to get to pay it back. And the reason that why people know it's a public issue, because why go to the state? If your car breaks down, you don't go to the state. But if your money breaks down, you go to the state. People recognise utterly it's a public issue. So I think, therefore, we have to understand money. And I have a completely different take on it from the last two speakers. I don't think public and private money can ever be separated. We need to understand how the money system operates, how money is created and circulated, and there are two views of money. You've heard the market view of money. Mine is a social and public view of money. Now, you've heard the market story a couple of times just recently. Originally, you've heard the word barter a couple of times, and it's in all the textbooks, in all the economics textbooks. So originally people bartered goods, which was inconvenient. So there was always a market, but it was a market based on barter. They needed a medium of exchange. You've been told this in the last couple of sessions. You need a medium of exchange, and some commodities are quite useful and turn out to be very useful, like gold. We've heard that story. Then the metal money has problems because it's not sort of very secure and it's awkward to carry around, so you end up with paper. But the precious metal must be kept in reserve for final payment, and this all leads to fractional reserve banking because the gold sits in the bank and backs the paper money. And we've had the idea just put to us that you should get back to that and put perhaps something like gold back to back the paper money. So this is the kind of commodity theory of money. But that view, which you've just heard, sees money as natural and neutral. That there are certain things, commodities, that have a natural value, and obviously gold, silver, ones. All forms of money are only a neutral representation of something that is the real economy, and therefore the government should keep its nose out, basically, and leave the real economy to get on and do what it can do very well, we're led to believe. I have a completely different view of money from this. I don't think money is natural or neutral at all. There is little historical evidence of barter economies. Money or forms of payment, not necessarily coinage, because that's very recent, has many origins in injury payments, dowries, tributes, tithes, taxes, and trade. But trade is only part of it, and a very recent historical part of it. Accounting and banking is much older than metal coin and this gold business, which gets us very confused. And precious metal coinage, in fact, has distorted our view of money. So we're misled if we think about commodities and coinage. Coinage in practice, coin has rarely been made of a fixed amount of precious metal. The weight of the coin has rarely matched the face value, which in many cases historically was not defined anyway, what the actual value is supposed to be. And precious metal coins were minted in too large denominations for ordinary trade. It never was brought out in small quantities. And in fact, historically, if you debased the coinage, that is, you made it less reliant on gold and silver, then you had a better economy because there was more money to go around. The commodity base actually shrinks your money basis. And in fact, but on the other hand, if you have too much precious metal, it can ruin an economy like Spain, which was really damaged by its discoveries of gold. So basically, we've got a completely upside-down view of coinage and the relationship to commodity. What is money then? It's not the medium exchange. It is important. That's what you've just been told. But that's not what's important. Money is an accounting mechanism, and you can account in many different ways and use many different measures. And money stuff has taken many forms, from metal to shells to paper to electronic records. And a shell is as much a token as an electronic record. There is no difference. There's not hard money and soft money. There is just money. And money itself doesn't embody value, as I say, even coins are only tokens. But obviously the commodity it's made of can be sold, but not as money. It can be sold as a commodity. And who's going to base yourself on gold? It's gone from £300 an ounce to £1,000 an ounce. It's not a safe and secure thing at all. It's a marketable commodity that jumps up and down in value as much as anything else does. So it's the only thing that makes a sound money is a sound society, because money only works. All money is a credit, all money is a claim for future consumption or future activities in some way. And the only thing that makes it sound is that your society will acknowledge that token and give you goods and services for that token. So sound money is a sound society, not money in itself. And the point about money is it has to be made. The trouble about the kind of myth of the barter market is that somehow money pops out somehow. So 1 minute you have a barter market, another minute, pop, you've got money. And there's no explanation really about how that happens. And that is because it doesn't emerge like that. Money has to be issued. It has to be issued, and how it's issued is important. And there are two main sources. There's authority, fiat money, or there's trade, commercial paper. And there is benefit in being an issuer of money. If you're the issuer of money, if you're the issuer of a credit, then you have a sort of first use, as it were, of whatever form that money takes. Now, historically, authority money has been very important, particularly in the issue of the various forms of tokens, including coinage. most early money was administered by power holders who used some form of nomination and of something, and it was could be made of anything: clay tablets, tally sticks, more recently 7th century BC coins. But the value of the money was set by the authority, like Rome, for instance, set the value of its coinage. And notes and coin, as we've been told, was still a fair part of our money until about until the 1960s or so, 30% or so. And the most important thing to understand when we talk about state issue of money is the relationship between money and tax. We're told the story entirely the wrong way round. You don't pay public expenditure out of tax. That is not the way it goes. Money tax does not raise money, it makes it circulate. Because people have to trade and engage to earn the money to pay their taxes. Because it's not the tax that creates the money, it's the issuer minting the money or producing the money or accounting the money that produces the money. Now, and that is, now why would people give their goods and services to the power holder, serve in the armies, or give their crops, or give their animals, or build their temples? Why would they do that for token? Why would you do it? Well, the only reason you would do it, as the British knew when they set up their colonies, is you tax it, and then they have to. You say, here I'm giving out all these tokens, and you're doing this work for me, and I want them back. And the fact that you ask for them back and you can enforce your taxation gets the money circulating. So tax is about the circulation of money. It's a monetary instrument, not a fiscal instrument. And we totally misunderstand it because we've got muddled up because of the importance of bank money, and that's muddled us up. We're seeing state money coming again with quantitative easing, but of course it's being put into the banking system. It's a complete waste of time. And somebody said, where is the money going? You know where it's going to go if it can't go into property anymore. It's going to go into commodities. It's going to go into the raw materials that enable us to live at all. And we're going to see commodity prices go through the roof because that's where all this loose money is going to go. And it's really, really serious. So how then do we get to bank money? And this is why capitalism and bank money must go together. It's now our main source of money issue. You've been told this already many times. Its origin is in trade-issued commercial paper. You've been told how that happens, that traders issue credit to each other, and they issue it on the basis of promissory notes, bills of exchange, with some interconnection with gold. I'm not saying gold wasn't there as a token, but it wasn't the money that then was replaced by paper. It was part of the whole kaleidoscope of things used as money. Now, how did banks come up? Well, what banks did was, if a trader wanted, a producer wanted to give their goods to a trader to go and sell, they would have to wait till the trader had been and sold the money, sold the goods, whatever it is, and brought the money back. So what they did was they issued an IOU on the bank. The bank paid the money up front to the producer, and then waited for the trader to go out and get the money to honour that credit the bank has made. So the bank must create money ahead of any deposit because it has to issue the credit in order to get the ball rolling. So this is why you can't actually do away with fractional